So in the last video on modern banking, we talked about how banks are intermediaries between people who need money for productive things and people who have money to lend out. We also talked about the risks of this mode of operating and how modern governments try to mitigate these risks. We promised we would talk about shadow banking, the ominously named sector of the economy that behaves like normal banks by acting as intermediaries, but that are not regulated like normal banks. It comprises non-bank entities such as hedge funds, money market funds, private equity firms, investment vehicles, and finance companies. These entities engage in credit intermediation, facilitating the flow of credit between borrowers and savers in a manner similar to traditional banks. But they operate without the same level of regulatory oversight. Shadow banking is defined by its less regulated nature, allowing greater flexibility but introducing higher risks compared to traditional banking. Additionally, the system relies on complex financial instruments, including asset-backed securities, repurchase agreements, repo, and structured finance products. The shadow banking system is composed of several key components. Money market funds play a crucial role by providing short-term funding to borrowers, ensuring liquidity in the financial system. Securitization vehicles transform various types of loans, such as mortgages or auto loans, into tradable securities, enabling broader access to capital markets. Hedge funds and private credit funds extend loans to businesses or engage in speculative activities within financial markets, contributing to credit availability. Lastly, the repo markets facilitate short-term borrowing by allowing institutions to use assets as collateral, thus supporting liquidity and leveraging in the financial system. Is shadow banking a big deal? I mean, if they hold $5 in total, who cares, right? As of 2022, shadow banking entities held approximately $63 trillion in total assets across jurisdictions, reporting to the Financial Stability Board, FSB, representing around 14% of total global financial assets. In comparison, traditional banks accounted for about 40% of total global financial assets during the same period. So shadow banking is big and growing. Why is it so big? Well, there are people with lots of money who are willing to lend their money out to earn a great return. Sure, they know that this is a risky proposition, but with risks come rewards. These people cannot let their money rot in some bank account, earning barely enough to cover inflation. So they look for better investment opportunities. Some can buy into the stock market, sure, but some, knowing that there are better opportunities out there, look for them. They put this money in hedge funds, investment banks and other institutions that lend it out for them, earning a hefty return. So far so good, right? Not so fast. Suppose that there is a run on the shadow banking system. What would that mean? Well, the shadow banks use short-term loans that are typically large to give out long-term loans. We call this maturity transformation. The shadow banking system is highly vulnerable to liquidity shocks and market panic due to its reliance on short-term funding sources, such as money market funds and repurchase agreements, to finance long-term assets like loans and securities. When investor confidence in shadow banking entities erodes, they may rapidly withdraw funds, creating a scenario akin to a traditional bank run. This sudden withdrawal of funds leads to a liquidity shortage, compelling shadow banks to sell their assets quickly at discounted prices. These assets often include financial instruments such as mortgage-backed securities, MBS, and corporate debt. The rapid liquidation, or fire sales, drives asset prices downward, further exacerbating the financial strain. Declining asset prices ripple through the broader financial system, devaluing similar assets held by retail banks and other investors. This chain reaction results in losses on the balance sheets of retail banks and raises concerns about their capital adequacy, potentially leading to solvency issues. So the first effect is that since shadow banks hold similar assets to those of normal banks, or as they are commonly referred to, retail banks, once the shadow part of the banking system starts selling off their assets, their price drops significantly, which reduces the asset side of the ledger for normal banks. If you will remember from our video, On modern banking, this is called insolvency, when the asset side is seen as too weak to cover deposits. Another significant issue with shadow banking is the interconnected credit and counterparty risks it creates. Retail banks are often creditors, investors, or counterparties to shadow banking institutions, making them highly exposed to the risks originating from these entities. For example, retail banks may lend directly to shadow banks or depend on financial instruments like repurchase agreements, repos, or securitized products such as collateralized loan obligations, CLOs, which originate within the shadow banking system. If shadow banks face defaults or liquidity crises, it disrupts retail banks' cash flows and heightens counterparty risk. A related problem is contagion through market confidence. A run on shadow banking entities signals broader systemic financial instability, eroding public trust in the entire financial system. This loss of confidence can lead depositors at traditional banks to fear insolvency and withdraw their funds, triggering a run on retail banks as well. Such interconnected vulnerabilities amplify the risks of widespread financial crises. This is what economists call systemic risk, where damage to one part of the system infects the other part of the system, without the latter doing anything wrong. So the system gets infected and a whole run ruins the whole thing. Has this ever happened? Sure, the Great Financial Crisis of 2008 was a great example of this. Let's go through a quick rundown. The Great Financial Crisis, GFC, of 2008 can be understood as a collapse primarily triggered by the shadow banking system, which had grown rapidly in the years leading up to the crisis. Shadow banks played a key role in creating systemic vulnerabilities that ultimately led to widespread financial panic and economic collapse. Here's how it unfolded. Before the financial crisis, the shadow banking system played a significant role in global finance. It comprised non-bank financial intermediaries such as investment banks, money market funds, structured investment vehicles, SIVs, hedge funds, and entities involved in securitization and the repo markets. What are repos? Well, they are short-term loans using collateral. A repurchase agreement, repo, is a short-term borrowing arrangement where one party sells securities to another with a commitment to repurchase them later at a slightly higher price, effectively functioning as a secured loan. A longer video on these weird things will be definitely useful if there is enough interest. But anyway, unlike traditional banks, shadow banks operated with minimal regulatory oversight, allowing them more flexibility, but exposing them to greater risks. These institutions relied heavily on short-term funding, such as repos, to finance long-term assets, creating a structural mismatch. They also created and held securitized products, such as mortgage-backed securities and collateralized debt obligations, which played a central role in amplifying risks in the lead-up to the financial crisis. The shadow banking system played a pivotal role in the housing bubble through the process of securitization. Mortgages, including high-risk subprime loans, were bundled into mortgage-backed securities and sold to investors such as pension funds, insurance companies, and hedge funds, generating liquidity for lenders. This practice contributed to the housing bubble, as lenders driven by the high demand for MBS issued increasingly risky mortgages, often to borrowers with poor creditworthiness. Shadow banks, in turn, relied on short-term borrowing to finance these assets, operating under the assumption that housing prices would continue to rise indefinitely, a belief that ultimately proved catastrophic. By 2006 to 2007, housing prices peaked and began to fall, leading to widespread defaults on subprime mortgages. This caused the value of mortgage-backed securities and collateralized debt obligations held by shadow banks to plummet. Shadow banks, which had financed these long-term assets with short-term borrowing, for example repos, faced a liquidity crisis as investors refused to roll over loans, forcing fire sales of assets that further depressed prices and triggered a downward spiral. The crisis quickly spread to the broader financial system, heavily affecting investment banks like Bear Stearns and Lehman Brothers, which were highly exposed to MBS and reliant on short-term funding. Lehman's collapse in September 2008 signaled systemic instability, while money market funds, previously considered safe, suffered losses, leading to a run on the shadow banking system and systemic liquidity shortages. Traditional banks were also hit hard due to investments in MBS and counterparty relationships with shadow banks, suffering significant balance sheet losses. This eroded depositor confidence, leading to bank runs and spreading the crisis to the traditional banking sector. The interconnectedness of shadow banks, traditional banks, and global financial markets caused a systemic collapse, freezing credit markets, deepening the economic downturn, and triggering global stock market losses. Governments intervened with bailouts and programs like the US TARP to stabilize the financial system. In summary, shadow banking played a central role in the financial crisis. The securitization of risky mortgages by shadow banks fueled the housing bubble, while their heavy reliance on short-term borrowing, such as repos, to finance long-term and risky assets, left them highly vulnerable to liquidity shocks. When housing prices declined, the value of mortgage-backed securities, MBS, collapsed, triggering panic and widespread investor withdrawals. The interconnected exposures between shadow banks and traditional banks magnified the crisis, spreading failures across the financial system. Ultimately, this systemic financial collapse required massive government intervention to restore stability. The 2008 crisis revealed how the shadow banking system, though outside traditional regulation, could amplify risks and cause catastrophic failures across the global financial system. It highlighted the need for better oversight and risk management in non-bank financial institutions. How we got out of it is another video for another day, but lots of people lost lots of money, and a legacy investment bank failed, just disappeared. Retail banks almost went belly up too, so the government and the central bank had to intervene to calm things down. Central banks were really active during this time, and we will talk about what they did specifically on our video about central banks. So shadow banking is another sector of the economy that acts like normal banks, but is not regulated like normal banks. There are some regulations on it, but no one really knows whether those regulations work to prevent crises. As with normal banks, preventing runs is a very difficult thing to do, but it is very important because a bank run, even if it is on shadow banks, can cause system-wide failure.